While Wall Street argued about interest rates, while algorithms traded paper contracts, something happened on the other side of the world that makes Manhattan look like a lemonade stand. $5.9 billion, 4 months, one nation. The whale has surfaced. And it isn't who you think. The metal is leaving the vaults. Shanghai just hit $105 while New York celebrates 94. In China, they've locked the gates. The global supply chain isn't breaking. It's already broken. The question isn't whether silver will hit triple digits. The question is, when the music stops, will you have a chair? Welcome back to Boring Currency Index. Now, if you've been around the block a few times, if you remember when a handshake meant something and numbers didn't lie, then you're in the right place. We don't do flashy headlines here. We do facts. Cold, hard, uncomfortable facts. So if you appreciate research that respects your intelligence, go ahead and hit that subscribe button. Think of it as marking your territory in a world that's running out of truth tellers. And before we dive into this economic earthquake, drop a comment and tell us, where in the world are you watching this from? New York, London, Mumbai, Sydney? Because what we're about to reveal, it affects every corner of this planet. Now, let's talk about the $6 billion elephant in the room. The financial media loves a good distraction. They love to talk about the Federal Reserve. They love to argue about interest rates. They love to show charts of tech stocks and pretend the entire world revolves around a few buildings in New York City. But while the experts were busy debating, while the traders were busy clicking buttons, something extraordinary happened on the other side of the world. For months, analysts had been watching the silver market tighten. The premiums were rising, the inventories were falling, but there was always a missing piece to the puzzle. The metal was leaving the vaults, but nobody knew exactly who was taking it. Some thought it might be China, others suspected industrial hoarders. The mystery remained unsolved until now. The whale has surfaced, and it isn't a hedge fund, it isn't a tech billionaire, it isn't even a central bank. It is the nation of India. According to the latest trade data, India has imported approximately $5.9 billion worth of silver in just 4 months. Let that number sink in for a moment. $5.9 billion in a market as small as silver. This isn't an investment. This is a hostile takeover. To understand the magnitude of this move, one must look at the historical context. From 2013 to 2019, India's silver imports averaged about $1.5 billion for an entire year. They used to buy $1.5 billion in 12 months. Now they have purchased nearly $6 billion in just 4 months. That represents a 400% increase, a fourfold explosion in demand. When compared to the peak of 2022, which was already considered a record-breaking year, this current buying spree is 64% higher. This is what economists call a step function change. It isn't a gradual increase on a chart. It is a vertical line. It is the sound of a nation deciding, seemingly overnight, that they would rather hold silver than paper currency. But why does this matter to someone sitting in the United States or Europe? Why should anyone care what happens in Mumbai or New Delhi? The answer is simple. Silver is a global asset with a finite supply. There's only so much of it above ground. When one buyer steps in and vacuums up 4 months of global production in a single quarter, that metal is gone. It has been removed from the game board. The silver India is buying isn't coming from outer space. It is coming from the London Bullion Market Association. It is coming from the refiners in Switzerland. It is coming from the warehouses that supply the COMEX. India is draining the West. And here's the critical detail that mainstream analysts are missing. They will say it is just jewelry demand. They will claim it is for festivals and cultural traditions. They want observers to believe this is just Indian families buying ornaments. They are wrong. A nation does not import $6 billion of silver in 4 months just to make jewelry. That volume signals something much deeper. It signals industrial stockpiling. It signals investment panic. India is rapidly modernizing its electrical grid. They are building massive solar parks. They are expanding their electronics manufacturing sector to compete with China. These industries require silver. They need it for photovoltaic cells. They need it for electrical contacts. The Indian industrialists are positioning themselves strategically. They see the mining deficits. They see the geopolitical tensions. And they have decided to secure supply now at $90, because they understand that waiting 6 months might mean not being able to acquire it at any price. This is strategic accumulation at a national level. While Western markets were celebrating, patting themselves on the back for silver reaching $94, something bizarre was happening 7,000 miles away. The traders in Shanghai looked at that $94 figure and they laughed, because on their screen, in their reality, silver wasn't trading at $94. It was trading at $105. Let that disparity settle in for a moment. 2 different planets, 2 different prices, same metal. In New York and London, analysts were still debating whether silver could hold above $90. Meanwhile, in the world's manufacturing capital, the The price had already blown past the century mark and was climbing higher. But the absolute price isn't even the most alarming part of this situation. The truly terrifying element, the piece of data that should make every short seller wake up in a cold sweat, is the premium. The spread between Shanghai silver and Western silver has just reached $11 per ounce. $11. To comprehend why this matters, one must look back at history. The year 2011 witnessed what many called the legendary silver squeeze. Prices went parabolic. Banks were on the edge. The system nearly collapsed. At the absolute peak of that crisis, the Shanghai premium reached approximately $7. $7 was considered systemic failure territory back then. Today, the premium stands at $11. That represents a 57% increase over the previous record for market dislocation. The gap has quadrupled in just weeks. This tells observers something crucial. The current crisis isn't simply a repeat of 2011. It is significantly worse. It represents a deeper, more fundamental fracture in the global financial architecture. Think about the mechanics of arbitrage for a moment. If someone can purchase silver in New York for $94 and simultaneously sell it in Shanghai for $105, they are making an $11 risk-free profit on every single ounce. This creates what physicists would call a black hole effect. Every ounce of silver that isn't secured, every bar that isn't locked in a sovereign's vault, is being pulled into this vacuum. The metal flows from the low-price jurisdiction to the high-price jurisdiction, or this explains why COMEX inventories are collapsing. The banks aren't selling silver to retail investors anymore. They are selling it to arbitrage traders who immediately ship it to Shanghai. The West is being stripped of its strategic resources because the paper markets refuse to acknowledge physical reality. The COMEX is claiming silver is worth $94, but the physical reality in the world's factory, in the place where silver is actually consumed to build products, is screaming that it is worth $105. Who is correct? The paper traders in Chicago, trading leverage and debt, or the industrial manufacturers in China, who actually need the metal to construct the solar panels that power civilization. The physical buyer is always correct, always. And the fact that this premium continues expanding tells observers that the physical shortage is intensifying, not resolving. If the market were balancing itself, the spread would narrow, but the gap is widening. This means that even with massive quantities of metal flowing east, it still isn't enough. Why? Because China is experiencing a severe physical shortage. China produces over 80% of the world's solar panels. They manufacture the majority of electric vehicle batteries. These industries operate on silver. If there is a shortage in China, there's a shortage in the global supply chain for everything from smartphones to electric vehicles. The $11 premium is the market screaming that the industrial supply chain is fracturing. Factories are bidding against each other for scarce material. They are paying $105, not because they want to, but because they must. High prices tell a story, but what comes next tells a different story entirely. If someone thought expensive silver was the only problem facing the global financial system, they were missing the endgame. High prices are merely a symptom, a warning signal. What follows is the lockdown. Reports have emerged confirming something that changes everything. China is quietly enforcing strict export restrictions on silver and silver-containing critical minerals. This is the ultimate Roach Motel strategy. Silver checks into China, but it never checks out. To understand why this is happening, one must stop thinking like a trader and start thinking like a central planner in Beijing. China is the world's factory. They produce the vast majority of solar panels, electric vehicles, and electronic components that modern civilization depends upon. These products require silver. For 20 years, the West was content to sell its silver to China. The arrangement seemed convenient. Let China handle the manufacturing, then purchase back the finished iPhone or solar panel. Everyone benefited. But now, the world has changed. Resources have become scarce. The mines are depleting. And China has made a strategic calculation. They have decided they will no longer export raw silver. They will not sell silver bars. They will not sell silver grain. If the world wants silver from China, they must buy it embedded inside a finished product. Inside the solar panel, inside the battery, inside the electric vehicle. This is value-added nationalism. It functions like Saudi Arabia announcing they will no longer export crude oil, but will happily sell refined gasoline at a premium. It forces the rest of the world to remain dependent on their manufacturing infrastructure. But here's the aspect that makes this export restriction devastating for COMEX and the LBMA. China is also a major refiner of silver. Much of the silver mined across Asia and even parts of South America flows through Chinese refineries. If China restricts the export of refined silver bars, they are effectively severing the supply line to London vaults. The LBMA relies on global flows to balance its ledgers. If the Chinese flow stops, and evidence suggests it has stopped, then London is attempting to satisfy global demand with a shrinking pool of metal. This explains the squeeze that observers are witnessing. The export restrictions from China have compressed the global market. This isn't an accident. This is economic warfare. China sees the United States attempting to reshore its industry. They observe the G7 nations meeting to secure supply chains. They watch America trying to build its own solar factories and battery plants. And China is responding with a simple message. Good luck building those factories without the metal. By hoarding silver, China is suffocating the re-industrialization of the West before it can even begin. They are weaponizing the periodic table. This transforms silver into a geopolitical hostage. The price of silver is no longer just about inflation or interest rates. It is about access. If someone is a Western manufacturer, they now face a terrifying reality. They cannot obtain silver from China. They cannot get silver from the US Mint because operations have been curtailed. They cannot acquire silver from dealers because supplies are rationed. They're entering a world of resource apartheid. The implications of China locking the gates are profound for Western silver prices. If the West cannot import silver from the East, the West must rely entirely on its own production. But the United States consumes far more silver than it produces. America is a net importer. The country relies on Mexico, Peru, and yes, China, to fill the gap. If China exits the equation, the deficit in the United States expands dramatically. The physical vacuum in India, the price explosion in Shanghai, the weaponization of exports by China. But there remains one more layer to this global puzzle. The layer that explains why smart money is abandoning the banking system and flooding into the mining sector with urgency. It is the return of the trade war. And this time, it isn't just a skirmish, it is a siege. Reports confirm that trade tensions between the United States and the European Union are escalating rapidly. The tariffs targeting the United Kingdom and Europe are starting to bite. But why does a trade war matter for the price of silver? Because trade wars are, by definition, inflationary. For 30 years, the world enjoyed the benefits of globalization. Silver could be mined in Mexico, refined in Switzerland, sold in London, and used in a factory in China. It was efficient. It was inexpensive. But when walls go up, when tariffs get slapped on imports and exports get banned, that efficiency dies. Friction enters the system. Cost increases. If a European refiner cannot ship silver to the United States without paying penalties, the price of silver in America must rise. It has no other option. This trade tension is the match that ignites the inflationary fire. It signals to the market that the era of cheap goods has ended. The world is entering the era of secure goods. And security carries a price. But the most damning evidence that global financial elites understand what is coming is not found in government press releases. It is found in the stock market. Specifically, in a chart that almost nobody in the United States pays attention to, but which is currently screaming danger: the Nifty Metal Index. For those unfamiliar with Asian equity markets, the Nifty is India's benchmark stock index, their equivalent of the S&P 500. And the Nifty Metal Index tracks the major mining and metal-producing companies in that economy. Why should anyone care about Indian mining stocks? Because India is the demand engine right now. They are the ones buying all the physical silver. So if someone wants to know where smart money is betting, they look at what Indian investors are doing. And what they are doing is historic. The Nifty Metal Index is having its best start to a year since 2018. It is surging higher, but here's the metric that matters most. The ratio of the metal index to the general market has just hit its highest level in 11 years. For the last decade, general stocks, technology companies, banks, consumer goods outperformed commodity stocks. It was the era of the tech bubble, the eras of paper assets. But this ratio breakout signals a regime change. For the first time in 11 years, miners are beating bankers, rocks are beating software. Capital is rotating. The smart money in the global economy sees inflation approaching. They see shortages materializing, and they are selling their general stocks to purchase mining stocks. They are positioning for a commodity supercycle. This validates the silver squeeze thesis from a completely different angle. The squeeze isn't just retail investors buying coins, it is a structural rotation of global capital flows. If the Nifty Metal Index is breaking out, it means the entire commodity complex, copper, zinc, lithium, and silver, is repricing. And most silver comes from lead and zinc mines as a byproduct. If mining stocks are soaring, it implies the market expects the value of what they extract from the ground to skyrocket. It creates a feedback loop. Trade war causes inflation. Inflation causes investors to rotate into commodities. Rotation into commodities drives up silver prices. Higher silver prices drive up costs of solar panels and electronics, which causes more inflation. The Federal Reserve cannot fix this. They can raise interest rates to 10%, But that won't eliminate a trade war. It won't make China export more metal. It won't make the Indian whale stop buying. Higher interest rates might actually worsen the situation. High rates make building new mines more expensive. Supply stays constrained longer. The breakout in the Nifty Metal Index is the warning signal. It is forecasting triple-digit commodity prices, and the U.S. market is beginning to listen. American mining stocks are awakening. Silver has reached $94, fueled by this global anxiety. The trade war is the friction, the rotation is the fuel, and silver is the rocket. Observers are watching price balkanization unfold. In a trade war, there is no global price. There is friendly price and enemy price. But because silver is money, because it is the ultimate neutral asset, it flows to the highest bidder regardless of alliance. Right now, the highest bidder is the one with the greatest fear of shortage.